Good evening, everyone. Time for another silver update. This is the 10-minute chart of silver provided by netdania.com. You can click on the link below. I've drawn a number of trend lines in here. The primary trend line is going to be our primary downtrend line that we're drawing from the Bernanke-Paul top when we had the coordinated smackdown on the 29th based on the Bernanke speech. You can see we're holding that line and we're rallying up to it. So that's going to mark the ceiling of this current move. I've drawn another trend line from this not quite as steep a slope coming off of this downtrending line here. I've also got the primary uptrend line, which you can see was violated today, and fairly rapid descent off of that, then a test back up to it and a failure. This was preceded by a very suspicious move in the Globex. If you were watching Sunday night, you saw a tremendous amount of churning that occurred on very, very high volume. You can see in the off hours we actually hit 30,000 contracts, 30,000 plus contracts in the off hours. So that was a highly suspect move there, and you can see it was followed by the failure of this trend line today. So where are we going with this? Well, I've drawn the bottom level of this move, and if you remember, the move was from 37.5 all the way down to 33.75. That was a full 10% move, and it was a $3.75 move. So very significant. The numbers are very striking there. And now you can see we're rounding down to test this low that we put in at the Bernanke speech. So the line has already been penetrated to the downside, and my guess is we're going to search and find some downside targets here below 33.5. That's going to be our new low that we're looking to test. The volume line I've drawn here is the same one I've been drawing. That is about 8,000 is the normal top for the volume. You could see once we had the Bernanke smackdown, we had very significant volume that occurred on the day of the smackdown, and we've continued since that time to have higher than normal volume. So it seems that they are selling things down to try to confirm this move and make it appear to be a top, a temporary top, and a downtrend move. And that's going to bring us into the main topic of the night. When I say things like they're trying to make it appear, I think it'll become clear when I start talking about the derivatives here of how we're in a tail wagging the dog situation now. So let's jump over to the main topic, and that's going to be derivatives. Let's read the definition real quick here. A derivative instrument is a contract between two parties that specifies conditions, especially the dates, resulting values of the underlying variables, and notional amounts under which payments or payoffs are made between two parties. So that's the basic definition. Now, it doesn't make it clear that when you're talking about a derivative, you're always talking about an underlying. That's the key. A derivative's value is derived from the movement, the price movement of the underlying, whether that be a stock or a commodity. And you can see when we get into the table here, it gets very complex. There's options, there's futures, there's all of these various bets that are made on the underlying and what direction it will go. You even have weather derivatives. You also have swap agreements, forward agreements, and option agreements. So these are all derivatives. They're all ultimately based on the underlying. And you can see when they give an example of hedging. Of course, hedging is where derivatives originally came from. I'll read it briefly. Derivatives allow risk related to the price of the underlying asset to be transferred from one party to another. For example, a wheat farmer and a miller could sign a futures contract to exchange a specified amount of cash for a specified amount of wheat in the future. So this is how the derivatives originated on the futures market. Now they've been applied to stocks and bonds and everything else, but really the idea is that you can make a side bet essentially on the price of the underlying, and in that way you can hedge. So that's the key concept with derivatives. Now what I want to look at with derivatives is the derivatives market specifically in regards to silver. So we've got a new site here that is a volume site that the CME has put up here, and normally it's very difficult to pull volume, but you can see that the CME, and I'll go ahead and link this site, the CME has provided a new site where we can actually check the days. Apparently this either only goes back a week or they've just started this, I'm not sure which. They may just have 5 rolling days. But anyway, I've chosen the 29th. If you remember, the 29th was the big day, the Bernanke-Paul smackdown. And I've chosen that because I wanted to take a look at the derivatives volume. So the silver future, and you can see you have silver future and silver, they add these together, and you've got the volume and the open interest. So the volume for silver on that day was about 127,000 contracts and 15,000 contracts. So total of about 140,000 contracts. Now, what's very interesting about this is you can see that we actually came very close to 100% of the open interest. So the entire amount of derivatives that exist for this particular futures contract changed hands in one day. And that may be related to, I can't say how, but related to some of the churning activity that we've seen. So, but just to give you the raw numbers and what this means, you've got roughly 140,000 silver contracts trading on that day, and that doesn't have the mini and all the other things in there, just a basic silver futures contract. 140,000 silver futures contracts times the 5,000 ounce amount per contract is going to give you about 700 million ounces. Now the other derivative I wanted to add in there is the SLV, and you can see that on February 29th, when we had a high of 36.44, we had a low of 32.9, so we had a very dramatic move, another 10% move there, and we trade about 91 million. So add those two together, you're talking roughly 800 million ounces of derivative silver that traded on that day between those two derivative instruments, because obviously the SLV is also a derivative of silver, although they claim that they have the silver in inventory. I highly doubt that they took delivery or changed hands, that these volumes are accurate. So I'm going to count this as a derivative of silver, and then we're going to jump back and do some simple math on that. So if we know the number that we cite very often is, we're going to cite 750 million. We could say 800 million, but we'll just say 750 million for round numbers sake. And we know that the 750 million is the amount that we mine roughly every year. We also know that there's about 250 trading days in a year. So we get about 3 million ounces that is the underlying per day. In other words, in the world, about 3 million ounces a day, business day, because we're doing the 250 trading days, we're not counting the weekend. So about 3 million ounces per business day that these contracts are traded is mined. Now we know that we had roughly 800 million that traded between the futures, options, and the SLV. So we're talking about 800 divided by 3. So we're talking about a ratio of about 266 to 1. Now, I'm assuming, you have to remember that I'm assuming that the amount mined per year is going to be the amount that's out there. Let's say that I'm incorrect and that there's a whole lot of silver sitting around out there that's been mined in previous years. Even if we give them a 5 to 1 ratio and we say that there's a good 5 times the yearly amount mined, so we say that there's roughly 375 million, or I'm sorry, 3.75 billion ounces of silver sitting out there waiting to be delivered, and I think we know that's not the case, but let's just give them that. We're still talking at that point of about a 50 to 60 to 1 ratio of the amount of silver that's mined every day to what is traded every day. So just for a comparative example, let's go over to the equity volume and open interest. Now, the first thing I want to show you here is we can use the S&P 500 or we can use these other contracts. There's a lot of them here. There's the E-minis, but let's look at the primary S&P 500. You can see that the S&P 500 future, and I assume this is S&P 500 cash, we'll just take them together. You can see that you got about 400,000 here of open interest, and you've got about 250 there. So we're going to say about 650,000 in open interest on the S&P 500 futures contract. And you can see over here we traded on the same day. I chose the same day as the silver, the 29th. You can see that we have roughly, add these two figures together, we get about 35,000. So we had about 35,000 contracts traded divided by that open interest of about 650,000, and that means it's about 5%. So while the S&P futures contract is trading 5% of its open interest on a daily basis, you can see the day that we saw silver traded nearly 100%. So there's a 20-fold difference in the amount of contracts traded versus the open interest outstanding. Now, if we look at the outstanding value of these contracts, you're going to have to add together these two and then multiply times the value of the S&P contract. Don't quote me on this, but I thought it was $1 million notional. I'm not sure what that number is for sure. But if you want to compare what that's going to be, then you're going to have to take the value of these futures contracts together times the value of one contract, and then you want to compare that to the outstanding value of the entire S&P 500, which is going to be, I'm guessing, roughly $5 to $10 trillion. So, and you can do this same study in all of the futures. There's a ton of futures. You can see here there's all the interest rate futures, other metal futures, agricultural futures. But the point is if you do that study, you're going to find the numbers are roughly the same. A small percentage trades every day, and that's actually the way it should be. This number here, which is the value of the outstanding derivatives on the underlying, is probably going to come in around 10%, and then the amount traded is going to be a tenth of that, so maybe 1%. So you're talking about 1% of the outstanding value of the entire market being traded in derivatives, and that's an actual derivative that we're talking about here. Now, my contention is that when we're talking about silver, when we're looking at these volumes compared to the amount of silver that's mined every year, my contention is that the silver, the physical silver, has actually now become a derivative of the paper silver price. So in the case of silver, which is partially true in gold, but more true in silver than any other commodity, the derivative is actually the silver itself, while the underlying is going to be this paper contract. Now, what does that mean? If the underlying that is the thing that all the money goes into is paper silver, then that means that paper silver is 99% going to be the determiner of price, and that physical silver price will actually be a derivative of that. And I think if you look at the price action that we see here, specifically the Bernanke-Paul smackdown, with the amount of silver, paper silver, changing hands there being more than an entire year's worth of mine supply, we've actually reached a situation in silver, and I think it's the only commodity that we're anywhere close to. We've reached a situation in silver where the underlying has become the derivative, and the derivative has become the underlying. And if that is the case, then it's just a matter of how much paper money is thrown at the underlying, the paper silver, to determine where the price goes, and then obviously the derivative, silver itself, is going to follow. Now, that can't last forever, obviously, because silver is a real commodity that's mined out of the ground, and it takes real wealth to pull it out. Eventually, this scheme is going to collapse, but as long as this scheme stands, then the underlying, which is paper silver derivatives, they're going to lead the price, and physical silver is going to follow. As long as that is the case, and you can still get physical silver connected to this price of this underlying paper silver scam, then obviously you're getting the biggest bargain in the world, and you want to stack until this reverses itself and the paper price becomes the derivative and the underlying is the physical, and then you're going to see a reversal of those ratios, which is, in my opinion, going to be 100-fold reversal. So you're probably going to see a 100-fold reversal on these, and probably a 100-fold reversal on the price. And we'll talk to you next time.